Welcome to the GSMC Financial News Podcast, the show that delves into the ups and downs of the stock market, changes in the economy, and news from the worlds of real estate and technology. From breaking news on the New York Stock Exchange, NASDAQ, or the overseas market, to updates on the bond market, if there's money to be made, we've got you covered. GSMC Financial News Podcast, brought to you by the GSMC Podcast Network. I am your host, Sarah. Today is Tuesday, April 7th, and we have many stories concerning the financial world, especially the financial world as affected by the coronavirus, by COVID-19. Today is also International. Let me get it right. Just a second. Okay, sorry, not international. It is hashtag World Health Day. So, hopefully you took some time to say thank you to everyone who is working so hard everywhere in the world to help take care of people who are affected by this pandemic. Let's go ahead and get started with our first story, which of course is to do with the stock market, as we always start. Today's stock market news, stock futures edge lower after today's late day drop. Stock futures were little changed to slightly lower this evening after trading choppily during the regular session. At the session highs during the day, the S&P 500 rallied a total of more than 22% above its March 23 closing low, or 3.5% on the day, before ending the session slightly in the red. Investors this week have been tracking mixed to slightly more positive developments in the coronavirus outbreak, with hotspots including New York and Italy showing improving trends in new cases and hospitalizations, even as new deaths for the Empire State rose by the largest number since the outbreak began. Politicians in other virus-stricken regions were less upbeat, however, with France's health minister warning today that the country had not yet hit its peak in the outbreak. Improving coronavirus case data and momentary risk rally aside, many analysts maintain that it would be premature to assume volatility will calm in the markets in the very near term. According to Neil Duda, head of economics at Renaissance Macro Research, it is way too soon to signal an all clear for the markets. First, as the news on the health front gets better, the news on the economic front will likely get much worse. 8 out of 10 U.S. counties are under some form of lockdown order amid the pandemic, according to a recent Wall Street Journal / Moody's Analytics study, with the bulk of those seeing billions of dollars worth of lost output daily as businesses stay shuttered. And the impact of these shutdowns will soon be reflected in economic reports released in the coming weeks. Duda said that April's economic data will be a tough pill to swallow, with monthly GDP likely contracting 50% at an annual rate. Next week, we get March retail sales and a couple of regional PMIs for April. He added that when social distancing measures do eventually ease, ultimately, quote, opening up the economy sounds much easier in theory than it will be in practice. It's not a switch, but a process, he said. Still, other prominent investors noted that the time of extreme panic may be in the past at this point, creating an opportunity for less drastically defensive positioning for market participants. According to Howard Marks, co-founder and co-chairman of Oaktree Capital Management, investors who favored defense over offense have experienced smaller losses this year, have the satisfaction that comes from relative outperformance, and are able to spend more of their time looking for bargains than dealing with legacy problems. Thus, I feel it's a time when previously cautious investors can reduce their overemphasis on defense and begin to move toward a more neutral position or even toward offense, depending on how sure they want to be of grasping early opportunities. He added, I'm not saying the outlook is positive. I'm saying conditions have changed such that caution is no longer as imperative. At 6:01 p.m. Eastern Standard Time today. I guess we're on Eastern Daylight Time now, aren't we? Stock futures open roughly flat. Here are the main moves at the start of the overnight session for U.S. equity futures as of 6:02 Eastern today. S&P futures down 1.25 points or 0.05%. Dow futures down 18 points or 0.08%. NASDAQ futures down 5.75 points or 0.07%. And that is your news on the overall state of the stock market today, Tuesday, April 7th. What else is going on? Well, stock futures decline, according to one article, after volatile session for markets. This comes to us from CNBC. U.S. stock futures were lower in overnight trading and pointed to losses at the open on Wednesday, continuing a volatile week for stocks gripped by the coronavirus shutdown. Dow futures dropped 236 points, implying a Wednesday opening decline of about 289 points. S&P 500 and NASDAQ futures also pointed to lower opens. Today, the Dow Jones Industrial, as we said, fell 26 points or 0.1%, giving up a 900-point surge earlier in the day. Today's stock market shows, volatility is likely to remain for some time, said Jim Paulson, chief investment strategist at the Leuthold Group. Some investors believed equities were getting ahead of the reality where coronavirus shutdowns are likely to weigh on the economy significantly beyond the second quarter. The major averages have rallied about 20% from their March 23rd lows. Goldman Sachs chief equity strategist David Kostin warned about a bear market rally that appears like markets have bottomed but turns out to be premature. Kostin said on CNBC's Squawk on the Street today, risk to the downside is greater than the opportunity to the upside from this point where we stand today. I would just remind you that in 2008, in the fourth quarter, there were many different rallies. I call them bear market rallies, some of which almost 20% a couple of times, but the market did not bottom until March of 2009. However, Monday's massive rally, where the Dow gained more than 1,600 points, showed investors are soothed by the first broad-based news that U.S. coronavirus cases appear to have fallen in recent days from their latest peak. If the curve is bending for the first time, some timeline is coming into focus for restarting at least parts of the economy, Paulson added. This means investors can start to reduce their best guesses as to how long this recession will last, and even if the recession is very deep, if its duration can be shortened and known with some greater clarity, this would tend to raise the value of the stock market. JP Morgan's market guru Marko Kolanovic said he expects a, quote, limited reopening of the economy in 2 weeks. True to his quant nature, Kolanovic is looking at smart thermometer data and believes it is confirming the outbreak is peaking in the U.S. He said, we believe we've seen a peak in new case growth in the U.S. 3 to 4 days ago, and then deaths will peak in about a week. So we look for a limited reopening of the economy in 1 to 2 weeks. And we think we will be able to recover the losses in equities sometime next year. Still, the cases in the U.S., the world's most affected country, topped 383,000 with at least 12,000 deaths, according to data from Johns Hopkins University. On Wednesday, the Federal Open Market Committee publishes its meeting minutes from its March meeting. In an emergency decision ahead of that meeting, the Fed cut interest rates to zero for the first time since the financial crisis. Although the Fed's minutes shouldn't be market moving, investors will get some insight into what the central bank is using as justification for its historic easing measures. Let's go ahead and take our first break of the podcast. When we come back, more financial news. Stay tuned. You are listening to the GSMC Financial News Podcast, and I will be right back. As we go into the break, I want to talk to you about Birch Gold Group. In 2008, as we were just mentioning, the U.S. national debt was $10 trillion. Today, it's over $23 trillion, and it's rising like a hockey stick. If you don't think we're sitting on a house of cards, you're living with your head in the sand. But since you're listening to this podcast, you are clearly intelligent and smarter maybe than the average American. So what is your plan? As one of the dealers of physical precious metals in the United States, Birch Gold Group helps Americans diversify their savings with gold and silver. Customers can purchase for physical possession or convert a portion of their IRA or 401k into an IRA backed by physical precious metals. Can you afford another hit to your retirement like the last downturn when the S&P dropped 50%? You can hedge against inflation and hedge against uncertainty and instability with precious metals. Gold is a safe haven against uncertainty. Thanks to a little-known IRS tax law, you can even now move your IRA and eligible 401k into an IRA backed by physical gold and silver. It's perfect for those who want to protect their hard-earned retirement savings from any future geopolitical uncertainty. If you look back historically, when the bottom falls out of everything, gold tends to safeguard savings. So if this is something that you are interested in pursuing, you can contact Birch Gold Group to request a free info kit on physical precious metals. See if diversifying into gold and silver makes sense for you. This comprehensive 20-page kit reveals how gold and silver can protect your savings and how you can legally move your IRA or 401k out of risky stocks and bonds and into a precious metals IRA. To get your no-cost, no-obligation kit, go to birchgold.com/finance. That's BIRCH gold.com/finance. Are you a business owner? Someone interested in the latest news that might affect your business? Then check out the GSMC Business News Podcast, a show dedicated to keeping you up to date on all things concerning business, technology, and the stock market. Get a head start on the day as we keep you updated on the latest goings-on Wall Street, money, jobs, and technology. The GSMC Business News Podcast has you covered. Welcome back to the GSMC Financial News Podcast. Before the break, we were talking about what happened on the stock market today, and now we're turning our attention to those SBA loans that many of you have probably already filed for. There was a frenzied rush to get those applications in, and now many are nervously waiting on bank approvals. According to one article, this comes to us from, again, CNBC. Jen Morrow is eagerly awaiting an update from her community bank, Sandy Spring, on a $30,000 loan request for her bookstore, Bard's Alley, in Vienna, Virginia. Since the start of the coronavirus outbreak, Morrow has gone from 12 employees to a staff of just 3, including herself, as her bookstore, typically filled with book clubs, customers in the cafe, and a community of readers, is now empty. She's gotten creative, delivering books to homebound customers via bicycle with a neighboring bike business. Meanwhile, she is hoping and waiting to hear about her loan. She said, "I am trying to run this business every day with a skeleton crew, worried about my staff who are at home, and now I'm holding my breath because I have no idea if I will even get a loan. There's not blame anywhere. I just don't know how long it will take to review my application and get the money." The government's $350 billion loan program is aimed at assisting small businesses hurt by the measures that have been taken to stem the spread of COVID-19. Since the program started, Morrow and other small business owners are anxiously awaiting notice from their lenders about loan approvals and are eager to see the much-needed lifelines show up in their bank accounts. While entrepreneurs rushed to get applications into lenders on Friday, when the payroll protection program rolled out, banks are slowly working to disperse loans. Some banks say more guidance is still needed from the Small Business Administration before moving forward, while others say they are not yet ready to process loans but are accepting applications. Government officials had touted loans being made available as soon as same day before the program, which is typically $20 billion a year, got up and running. Jason Duff, founder of Small Nation, a company that works to revitalize small cities and towns, has been working with Bellefontaine, Ohio, to open up consumer-facing businesses in the city over the last few years. He is working with Richwood Bank, which told him and his business associate Adam Rammel, owner of local tap room Brewfontaine, that they had been approved and their loans have an SBA number. Duff said, they told us, quote, you have been approved by the SBA and we will be funding a separate account that you can draw from just as soon as the SBA gives us the guidance on if they need us to have you sign anything before distributing funds. That seems to be the last step and what's holding things up to get the money. As of yesterday, Monday afternoon, the SBA said more than 2,400 lenders were able to participate in the program, up from 1,800 at program launch. A senior administration official also said that beginning Monday, the administration would be offering a lender hotline, and its 68 district offices across the country would be available to assist lenders. But some lenders are holding back. Fountainhead Commercial Loans, one of 14 non-bank SBA direct lenders, has not started processing these PPP loans as of Monday. A spokesperson for the lender said they were accepting applications. Fountainhead founder and CEO Chris Hearn said last week that SBA had not provided adequate guidance needed to service the lender's, quote, tremendous queue of small businesses seeking loans, and warned most of their company's businesses will, quote, be dissatisfied with the speed of the process, end quote. A senior administration official told CNBC he could not speak on behalf of banks with regard to any guidance they may be waiting on. Banks submit applications to the SBA and secure E-Tran loan numbers before being able to take further action with regard to dispersing the loans. As of Monday afternoon, the SBA has signed 130,000 loan numbers with a value of more than $38 billion. But it's unclear how much of that capital has made its way into the hands of small business owners. SBA Administrator Jovita Carranza tweeted about a local business in North Carolina that had received funding from its lender, but broader details about the total amounts of funds lent to businesses were not made available despite multiple requests. Ann Harper, CEO of OMG Accessories in New York City, said she is in a holding pattern waiting for more detail from her lender, Chase. Harper received an automated email confirming her inquiry was received, and on Monday she was contacted to set up a call for Tuesday. We know how important this funding may be to you and your business, the email said. Harper has gone from 20 employees to 5 with her company, which sells bags and accessories, including her signature unicorn backpacks, online and in major retailers. Harper said, I'm hoping that these loans that we're applying for are going to give us the necessary funds to be able to bring back all of our staff and have everything functioning the way it did before all this happened. Barry O'Donovan of Kilkenny House in Cranford, New Jersey, is eager to take on a second SBA loan for $159,000 through the PPP. It would be on top of an existing disaster loan that was tied to damage to his store incurred during Hurricane Irene in 2011. He plans to apply with Santander. In the meantime, he has gone down from a staff of 30 full-time and part-time workers to 11. The restaurant offers curbside pickup 6 days a week from 4 p.m. until 8 p.m. O'Donovan said, we have not heard if Santander is ready to go yet. That puts us behind the 8 ball. I don't know if other banks will roll out before them and the money will be gone. I've gone into my private money and lent the business a loan. It's the beginning of the month and everything is up. So it sounds like small businesses are definitely in a holding pattern. Some have gotten some answers, many have not. It's just a waiting game, which when you are trying to run your small business can be extremely scary, not knowing what is going to happen, where you're going to go next. Just a lot of anxiety in a time that is already fraught with anxiety. That can be very, very difficult. So hopefully things will start moving in a positive direction. Let's go ahead and take our second break of the podcast. And when we come back, we will be wrapping up this episode of the GSMC Financial News Podcast. So stay tuned and we'll be right back. Do you work in the world of marketing and advertising? Are you a media buyer or the owner of an agency? Have you been looking for a podcast to help stay on top of all the goings on of those worlds? The GSMC Marketing News Podcast is dedicated to keeping you up to date on all things concerning marketing and advertising. Get the latest marketing news, from what major businesses have planned for the coming year to the newest trends in advertising, from podcasts, digital and streaming to the old standbys of radio, television, and billboards. The GSMC Marketing News Podcast has you covered, whether you're a marketing agent or a business trying to expand your brand. Welcome back to the GSMC Financial News Podcast. Before the break, we were talking about those small business loans and the uncertainty surrounding them, the hope that exists about them and for them, but not sure what is going to happen there. Next story, Exxon cuts capital spending by 30%, but the CEO says it's committed to maintaining dividend. This article was published today. And Exxon is slashing its 2020 capital spending plan as depressed oil prices hammer the energy sector, but CEO Darren Woods said that the company's dividend is safe for the time being. He said a lot of our shareholders are retail shareholders, people who depend on that dividend, so we've been pretty committed to maintaining that, and if necessary in the short term, using the balance sheet to support it, Woods said Tuesday on CNBC's Squawk Box. It's a capital-intensive commodity business, so we know we're going to go through cycles, and the way we have prepared ourselves to manage through those cycles is to maintain a strong balance sheet, he added. Shares of Exxon rose 1.9% today, although the stock has shed more than 40% this year. On Tuesday, the company said that it was reducing capital spending for 2020 by 30%, from $33 billion to around $23 billion, and cutting operating expenses by about 15%. The largest share of the reduction will be in the Permian Basin, where it's easier to adjust short-cycle investments, Woods said. U.S. West Texas Intermediate crude has slid 56% this year as the coronavirus outbreak has sapped demand. At the beginning of the year, a barrel of WTI fetched more than $60. Today, it trades around $26.44, hammering the highly leveraged energy sector as producers struggle to break even with lower prices. The fact that we've lost 23% of demand here in a very short order, that's a huge transition for the industry to make. Capacity has to come offline, and there will be economics that drive that force the producers to shut in, Woods said. The market will address the shut-in and drive levels down, frankly, because there's no demand for the product, and so eventually you have to stop making it. Further hammering oil is a price war that broke out between Saudi Arabia and Russia in early March after the last round of OPEC talks ended without a deal on production cuts. After the prior cuts expired on April 1st, Saudi Arabia was among the nations that ramped up its production despite the fall-off in demand. The group is set to meet on Thursday to discuss possible production cuts, and there have been calls for nations outside of OPEC, including the U.S., to participate. Woods said that the company doesn't factor the decision-making of OPEC into how it operates its business. He said, we've always focused very much on the fundamentals and trying to understand what the demand in the world would be over time, and making sure that as a producer, the supply that we bring into the market is low cost and therefore can effectively compete with other low-cost producers like Saudi Arabia and Russia. Looking forward, Woods is confident that there will be a recovery, but said the company is prepared to scale back even further if necessary. We have additional options to further reduce spending if necessary. I think with the uncertainty, we want to keep those options available to us. And as we move through the next month or so, we'll keep a very close eye on the market and continue to adjust if we feel the need to. In the short term, Woods said the dividend is a high priority, but that it will be a function of how long this plays out. He said, if we haven't seen a recovery next year, it will be a different environment that we are in. And that is the news from the oil world here in the United States. Our last story is SoFi is to acquire payment software company Galileo for $1.2 billion. Things are still happening in the world, despite everything that's going on. Of course, things are still happening. Personal finance startup SoFi has agreed to buy payments software company Galileo for $1.2 billion. The cash and stock deal will help the companies launch new products, expand internationally, and capitalize on consumers' shift to digital finance, according to the CEOs of both companies. SoFi CEO Anthony Noto said that a shift to digital has been accelerated by the coronavirus shutdown as people lose access to physical bank branches. It's the right time to do something like this. We're on the precipice of a transition to digital from physical finance, Noto told CNBC in a phone interview. It's going to serve people in this environment, and the need for mobile financial services is only going to accelerate. Galileo has been around for a decade, longer than its acquirer. The Salt Lake City, Utah-based software company connects banks to credit card processors through APIs or application programming interface software. The two companies first started working together early last year when SoFi began using Galileo as its payments processor for SoFi Money. Deal conversations began before things got challenging due to the coronavirus, but they were able to continue despite the current economic shutdown, according to Noto and Galileo CEO Clay Wilkes. Galileo also works with many of SoFi's competitors, including Robinhood, Chime, Monzo, Revolut, Vero, and TransferWise. Wilkes, who will stay on as Galileo's CEO, and Noto said the companies will operate independently, but it's possible some fellow fintechs will balk at the competitor owning their software partner. Still, the CEO said the deal is likely to benefit Galileo customers by helping them expand into new product lines, such as lending. Wilkes said, we see product roadmaps that have big gaps in them that can easily be filled with the products SoFi has developed. Now is a good time to do this. SoFi, which was last valued at $4.8 billion, has attracted investments from SoftBank, Kedar Investment Authority, venture capital investor Peter Thiel, and Silver Lake, amongst others. It launched in 2011 with student loan refinancing and has since expanded to personal and mortgage loans, refinances, wealth management, as well as credit card and a cash account, and stock and cryptocurrency trading. The deal is comprised of $75 million in cash, $250 million in seller financing debt, and $875 million in company stock, according to people familiar with the negotiations who asked not to be named because details were not disclosed. Elsewhere in Silicon Valley, deal flow appears to be slowing down. Multiple venture capital investors are telling portfolio companies to tighten their belts and, quote, survive the current economic shutdown. More than 1,200 startup employees have been laid off since March 11th, according to one real-time tracker. Noto, Twitter's former chief operating officer and a former managing director at Goldman Sachs, said the two fintechs are stable and performing well during an unprecedented time for the U.S. He said every industry is getting impacted and it's hurting every person in the U.S. right now. They need access to money and financial services now more than ever. Both companies are doing really well despite the challenging environment. So that is our last story for this episode of the GSMC Financial News Podcast. Thank you, as always, for joining me. Please join me again next time when we will have more stories of the economy, and I'm sure more stories of how the coronavirus pandemic is affecting the economy. On this World Health what I said at the beginning. Totally forgot the hashtag already. I spend too much time in isolation. It's eating my brain cells. Anyway, say thank you to people who are making it possible for the rest of us to stay home, stay healthy. Those who are making it possible to get healthy if you contract COVID-19. Thank you to all of the medical staff, doctors, nurses, janitors, everyone who makes hospitals run so very well, and we are so very appreciative. Hope you're having a great week so far. Please stay home. Save lives. Join me next time. Thanks. You've been listening to the GSMC Financial News Podcast, part of the GSMC Podcast Network. You can find this show and others like it at www.gsmcpodcast.com. Download our podcasts on Apple Podcasts, Stitcher, SoundCloud, and Google Play. Just type GSMC into your favorite podcast app to find all of the shows from the GSMC Podcast Network. From movies to music, from sports to entertainment, from business news to weird news. Please subscribe to the podcast and follow us on Twitter and Facebook. Thank you, and we hope you've enjoyed today's podcast.